Welcome back to another Market Insights. I am Chris Arends. That is Aaron Tuttle. And he's been teasing for a long time that we would finally hit a
I'm so excited.
A 2030 depression call that everyone tells me is going to happen. I'm skeptical. Professor Siegel was very skeptical on this exact set.
2030 depression? 4 years from now, you're picking a depression? Are you kidding me?
If you haven't done so already, make sure you hit that subscribe button. And if you're like me and you're in a Vistage group and all your friends continue to talk about ITR, make sure you share this with your friends. And while you're down there, make sure you subscribe to Spotify because your friends are probably on Spotify and you should be too.
But first, we do need to hit current market themes. There's a lot going on.
Anything about AI?
It's really just AI. I mean, the overall stock market has drifted lower a little bit, but a lot of it's under the surface, just internal moves. I think it shows people exiting one trade but needing to stay invested, so they're just going elsewhere. And I think the good thing to show this would be this study out of Harvard Business Review. It's not a study. I don't know what you'd call it. It's one company. So you could find data that doesn't. Did I hedge that enough? You could probably find something on the other side.
I don't need a study to actually know that this is a true statement, right? It doesn't have to be from Harvard to know that what AI is doing is not taking away work. It's actually adding work.
Yeah.
The pace that we're going at, I know internally, is just off the charts.
You find some new feature that you use, and you're working a lot harder and longer hours on it, but you're able to do more things. Right. And that's basically what the study showed.
And in our Vistage forum, we were talking about it. There is this thing that we got to go through as humans where we're no longer going to see our work as really task-driven as it is purpose-driven. So therefore, you can work longer because your why is being answered on doing it. Now, we may be getting a little bit too far, and maybe there's some very big producers that are a little too productive and a little too high-strung from it. But yeah, I don't see us being replaced. I see us actually working more because we're more effective.
Yeah. And because it was AI week, I spent a lot less time on these slides. It's actually from Claude and Anthropic. They shot this out in under 15 minutes of prompting, the lowest amount of slide preparation we've ever done, which means we spent more time doing other things for our clients. Last week, every single day, there was some new AI enhancement, some feature somewhere that sent down a specific sector, in really more of an industry, a smaller niche. Monday, it was insurance brokers. Tuesday was one that we're really familiar with, the wealth managers, and that's when we kind of said, this is getting a little overblown because they're taking out 10% of stock values on a small financial planning tax tool where we know that's not going to drive a huge impact in the valuation of a business just from that small tool.
Right, and I think it makes sense that premiums that a lot of these companies have been able to pull because of their very unique moat on creating software needs to come out, but these software are not.
What do you mean by
replaced.
premiums?
So whenever you work with a company like Salesforce, the amount of money that you have to pay for a tool is well above the amount of labor time and labor cost, even at that high amount. But you will willingly pay for that tool because it's going to make you far more productive. And they have a moat around that very few people have the skill set to do it. That part is coming out of the system.
I think they wanted 40 grand when we implemented with them.
They wanted 40, so I agree with AI is going to change that space, but I do think a lot of the AI narrative is now getting built in where it's extrapolating a linear progression of all the work that's been done on AI that soon will have no need to have these softwares because AI is going to do it all. And I just don't think we're going to hit that.
Salesforce is a little more complex, and it's not a company we own. And one of our analysts has been looking at it because he does think it survives the AI issues. I think a better example is even something we use for our tax planning software, Holistoplan, which I know Dan's been working on this. He could recreate that with an AI agent pretty simply, just to get the code. It would have errors, but you'd have to maintain the code for Holistoplan. You don't get the CEO of Holistoplan. Anytime there's a tax proposal, he posts a video explaining what it is, talking about how you use it and how you should model it. So that's value from the software provider Holistoplan. And the question is, at what point do we say it's better to take this internal for something so simple?
I don't think there's ever a point that we do that. And the reason
But
is
they can't keep raising their prices every year on us.
they will not be able to continue to raise
And that's
their
what you mean
prices.
by premium.
But yes, but there's not a barrier to entry whenever it comes to AI. If everyone can do it, then that's just going to make a holistic plan that much more inexpensive to run. But they're still going to specialize in that. They're still going to add different features. The cost of producing that. So then the cost of holistic plan comes down. Why would you go build that out whenever you have access to it? It's not an expensive tool as it is. So I just think the premiums that people have, because it's like they have the unique skill set, that comes out. But these softwares are
in
not
the short
go away.
term, the market doesn't go through that conversation we just had. They shoot first and they'll figure it out later. And
Yes.
part of that is just market structure. Hedge funds have been wanting to short something for a long time. It's been a year since they really got to hit a decline. Or if you remember last year, we even were saying it on here when we're trying to catch the tariff lows from a little less than a year ago. And I talked to a few hedge funds and they're like, we're going to just keep shorting the market until there's a reason not to.
Right.
And that reason ended up being a tweet from the president essentially saying we're taking tariffs down and buy stocks. And that shot up stocks 8% that day. And that was the short covering day. I don't know what that is for software. What is the thing that's going to keep them from keep hammering these trades? I don't know if it's cash flow, realizing that they're not actually going down in the short term. But at least in the most recently, it looks overdone. They've made a lot of money doing it. Some of those names are down 30, 40%. Maybe that's enough for them just to say, hey, our thesis came true. I don't need to ride this to zero. We made money. And that starts to cover and puts some support there.
I think a lot of that is going to come from the realization that we're very far on the innovation curve. So we're about 80%, maybe higher, depending on what industry or domain. And then that's going to level out. The complexity to go further on AI requires all kinds of new supervision around these AI bots, and the price of a token, which is the cost of doing skill set, is continuing to go up as energy goes up. But then the need for the tokens is going to be a 10 to 50 times X factor. So at some point, the cost of running these AI bots exceed the actual cost of a human working on it. And I don't think we're that far off from that realization. We have augmented tools where we have human intervention, human supervision. But to get to the autonomous tools, I think the price of tokens are going to make labor look cheap relative to the next level. And then that's when things will actually start to steady. And so I would say that the software companies are probably oversold. Their prices were too high. They needed to come down, but they're extrapolating out worst case scenarios. It's probably somewhere in between. So these are undervalued. If my thesis is correct, that these are going to stabilize and move forward, this would be a buying opportunity for us.
Not our style to catch a falling knife.
No, it's not our style.
We don't have a lot of software exposure. We like that we're in a good spot, but from a standpoint of saying we think it's going to stabilize, I think that's supportive for the rest of the market as a whole, which obviously we're exposed to. Probably a good time to move towards productivity and why we disagree with ITR's claim. So going back at least 15 years, 2014, I think you've been saying it's longer than that.
I believe it's longer than that.
They've been calling for a recession in 2030 and lasting at least 5 years, somewhere in that range of 2030. Now, they haven't really been updating it. They've stayed true to it. And looking back when they first made that call, you remember coming out of 08, everyone thought we'd return back to recession. Right? It took 5 years before people said that was behind us. Not that was their call. As you know, it's a long-term theme call that they're making. But let's just go through some of the drivers of what they would say.
But I do want to stay back on that they haven't revised. Because there's a lot of new information that's come out since 2014. We have AI coming out. We had all kinds of the fracking revolution where energy was becoming more abundant. Coming out of the aughts, we were running out of gas. We also had COVID and the whole change. So they either have a signal that hasn't changed, and that's what they're basing everything off of, because it can't be that they're taking all this data and projecting out, because you couldn't have seen these things happening in 2014, so they can't be factors. Otherwise, they would need to be revising their model, and they haven't.
Let's be fair. The one time we'll try to be really fair. the changes that we've seen in AI in the last month were large enough that we didn't talk about it a month ago.
Sure.
We're talking about it today. Maybe that works their way into productivity gains and they delay their call. I think that's what they should do, because they're early on any call if there is productivity gains. But the main features are really that there's going to be this decline, markets drift downwards. We're selling courses to your businesses, which there's nothing based on this view to help your business get ready, small business. We sell the same thing to our clients, our view for portfolios, so there's nothing wrong with that. But there is always this thing about saying, hey, the depression's coming, now let's prepare your business with our courses. It's always been a tough selling point that I haven't liked. And then they always said that the government's response will be ineffective. My main takeaway is, and you said signal, there's no signal here. We'll look at a couple things of saying, how do I position a portfolio based on this signal? And I think the way the government can kick the can down the road on any issue is underestimated, and it can take a lot longer than expected for some of these issues.
I do think that they have a value that they're really overweighting, and that's why they haven't made changes. I do agree that the government may be ineffective in what we want to achieve, but there are things that they will be very effective on doing whenever it comes to strategy and how you protect yourself. Because I do think that there are some underlying structural problems that ITR is taking into consideration that are real, and we could have a pullback in 2030, and they could be right on the reasons, but the strategy that they advocate, I still think, is the wrong strategy if they end up being right.
Let me just go to the signal part. So this chart actually came out last week. It was pretty timely from Apollo. The left hand is Japan births and deaths, and you see they cross each other around 07, 08. So if you said there's a signal, would you have gotten a good trade? Well, if you exit markets in 07, fantastic trade, good job. Well, that wasn't really the reason for the GFC. So, but to be fair, that if you exited based on this, your returns would have been much better. The total returns since 07 in Japan were only 100%, that annualized to under 5%. But if you waited till after the GFC where things got worse and said, here's my signal based on these population dynamics, you missed out on 9% annualized return. So when I sit here trying to say, how do we construct a portfolio based on population decline, it didn't work in Japan, at least as a signal.
Right.
And the second point I'd say is, because a lot of people point to debt-to-GDP as the other signal, and when we got this huge spike, and really what happens is you move quickly, I don't have the chart, but you move quickly, you stabilize, and you move quickly again with these debt bursts. And we're kind of in the stabilization point here at 130% debt to GDP.
And the reason these are important is because these are things that ITR continues to say. This is the problem that we see, the aging population of demographics, and with that becomes entitlement spending and healthcare costs that go up, and inflation, which is all creating an unsustainable debt cycle.
Yeah.
So these are the calls and why they haven't changed their model really through all of the different fluctuations, because this is their main thesis.
And to a lot of people thought that Japan would have a problem for it. Now, their markets, stock markets have been great. Bond markets are wild. You know, we've avoided them completely for that reason. But they were able to, my original thesis is they kicked the can down the road a lot longer than people thought, and returns were higher in that market than we thought too. And I think that's exactly what's going to happen here.
Right. So if you just take, well, let's look at demographics in Japan, which was not the cause of the lost decade. Right? I do want to recognize that before I get a rebuttal, hey, Japan is a bad example or a great example for their thesis. Their lost decade wasn't the demographics. They have roboticized, if that's a word, a lot of their economy.
I'll allow it.
But what happened is in the 90s, they were very accommodative in their monetary policy, which caused an enormous stock market bubble. And as they had to become restrictive, because at one point there's a plot of land in Japan that's worth more than the entire city of New York City, they knew that they had to pull that back. And that's what caused the decline in the market, is actually having to step in and become restrictive relative to the monetary policy that they had before. The demographics did not have the impact of the lost decade.
It's just I mean, it's a tough market when you look at Japan, because they boom and bust really aggressively, and I think our view on the boom and bust cycle really goes back to the Austrian monetary view. You taught me it. Do you want to take that?
But it's because they're calling for depression, and they reference the 1930s, and similar to Japan, what happened before the lost decade in Japan? A very hot stock market because of monetary policy of the Bank of Japan. What was before the 1930s here for the Depression? A very hot market in the 1920s where the Federal Reserve was expanding the monetary policy, and they could do it substantially because of all the innovation that was happening and the industrialization of the economy, that the prices on using Fisher's Index wasn't showing up. So eventually, whenever they had to pull back in the 1930s, we had a depression because the monetary policy became far more strict, and that was what caused the depression in both Japan and the U.S.
So price of money is too low, so people borrow more money. They build things, generally called malinvestment in the Austrian cycle, and eventually that corrects as money gets more expensive.
Correct.
Right? So if you're looking at it today, to be fair, what's the big build out we have going right now? It's AI, it's data centers. When you look at the entire market, it's hard to isolate a sector that's not exposed. The industrials are building them out. Tech is obviously part of the data center. The utilities are giving the power. And there's these huge moves in all of those sectors. So if there is malinvestment, if we're not seeing productivity gains, that will be the cause of the next bust.
Correct.
And that would be completely in our theory of what the Austrian school says of investments. Our view is we're going to see the productivity gains, and the investments, there will be malinvestment, but most of the investment as a whole will still be productive.
The other thing is that the central bank has to become restrictive at to end that regime, and I think that is an incorrect understanding. Because we've had the 1930s, because we have Japan's example, central banks are all very familiar with this. I remember when Ben Bernanke, who said he was a student of the 30s and is referencing Milton Friedman, the problem was we didn't expand the money supply. That's what caused it. But I think that we would have a continuation of that expansion. I don't think the government is going to say, hey, we have entitlement spending going out of whack, our debt is too high, inflation could be the one thing that would cause them, but
that's the problem. If inflation is elevated, right, they will respond. And this is something that Professor Siegel always talks about. Inflation is good for business as long as it's not too high that the central bank has to fight it.
Correct.
So if we're in that range where we are now, 2.5, and it's not significantly elevated, the central bank can stay accommodative, and that gets you a continued boom.
So then I think whether you get the continued boom or not, I think that is the policy procedures of the government to continue to try to solve the problem through expansionary monetary policy. Doesn't make the economy go well, but if your strategy is we're going to have a 1930s deflationary depression, which requires the central banks to become restrictive, not accommodative, and you go to cash, you're going from the frying pan into the fire, because that is unlikely to be the scenario that we find ourselves in as the 2030s come around, if ITR is right on the demographics causing a pullback and a slowdown in the market. But the Fed doesn't restrict, they instead add additional money. Going to cash is the worst strategy.
To close out that view, the most simple form of growth, GDP, is there's all sorts of different, you've actually mentioned, I think, 3 of the equations already. The most simple is just some form of labor, people,
right,
and giving them capital or technology to improve their work. And that's what we've shown here as the model, and the equations have all different weightings, but to keep it simple. So we're saying labor comes down, labor force restricts, and eventually outright decline in population to have that call. Now, if we're not having that offset with technology, you get everything we've talked about, the bad examples. Our view is just there can be an offset from productivity. We're going to see it. We're just starting to see it. And that continues strong enough to continue growth.
Right. that as long that we have the capital and we certainly have the technology to improve the effectiveness of that capital, it's okay if we have less people driving that capital, especially if a lot of the capital with AI starts to actually be part of what is creating labor in the system.
Thanks for joining us. Next month will be the 1 year since the big tariff sell-off of 2025. We'll revisit some of that, look at some of the winners, and see what markets are up to.